Hey everyone, welcome to today's show on Wealth Strategy Secrets. Today we're joined by Casey Meyeres. Casey is a tax partner with Provision, serving successful business owners, entrepreneurs, professionals, and investors with tax and wealth planning to help achieve their goal of financial freedom. With over 24 years of experience in public accounting, ranging from tax and audit compliance and consulting for a broad range of public and privately held companies, business owners, and high net worth individuals. Industries for Casey include real estate, construction, retail, manufacturing, communications, information technology, media publication, home building, and professional services. Casey holds a bachelor's in accounting and finance from the University of Arizona, and he's also an active member of the AICPA and ASCPA. Casey, welcome to the show, my friend.
Hey, Dave. Thanks for having me. Appreciate it.
Yeah, absolutely. Really excited about our chat today. I know investors are going to get a ton of value out of this. And I really just have to kind of kick this off, right? So, and provide full disclosure as well as, you are my CPA and have been for, I think, 7-8 years now.
Yep.
But before that, I ran a few different businesses and spent about 15 years really trying to find the right CPA. And it was this crazy journey for me where I literally hired 5 and fired 5 different firms because I knew that there was a different approach out there. And once I started learning more, right, about taxes, I knew that someone could really fulfill that. And I wanted that person on my team player. So just kind of want to provide a little bit of, backdrop that this is, you guys are not your average CPA, and, we can kind of talk about that a little bit. So maybe to just, kick things off, let's talk a little bit about your background, Casey, for folks, who aren't, familiar with you. How did you get into, your trade as well as, your own wealth journey?
Sure. So I've been in public accounting for about 25 years now. I think in January it'll be my 25th year. So I've seen quite a bit in my 25 years. I joined Provision. It was a little over 10 years ago. Prior to that, I was working for Deloitte, which, excuse me, at the time was the world's largest public accounting firm. It still might be, but I was in their private client advisor group, so high net worth entrepreneurs, small businesses. Our definition of small business went up to 100 million of revenue, and so really I wanted to become a partner. Deloitte had more director opportunities. Partner was really what I wanted. Equity part, be a part of the group. I got connected with Tom Wheelwright with Provision and became partners with him. Subsequently, a few years ago, we actually bought the firm from him. We're still closely tied with him, but we did equity buy the firm from Tom. So really going from Deloitte being the biggest CPA firm in the world, but it was still very backwards looking. So a lot of compliance type thing. So you would think, coming from such a large firm that it would be, forward thinking. Provision was definitely unique in that, as far as we really took the tax piece of it, because for most entrepreneurs, small business owners, tax is one of the largest expenses that you have. And so Provision was unique as far as, one, we try to identify how do we lower the tax, because that's the biggest burden that you have. And then once we lower that tax, now we have more cash, more capital. And how do we get that snowball rolling? How do we build that wealth and build wealth in a tax efficient manner? So, the last 10 years, so I've been doing it for 25 years. The last 10 years, I've learned so much from my clients, all entrepreneurs, small business owners, but also in that journey. So I've, increased my personal wealth, my own personal wealth strategy, but really I've hundreds of clients, as far as, taking their tax from, you might have a $300,000 tax situation, and we're able to, some cases, wipe it away completely, some cases cut it in half, some cases, cut $50,000 a year, but really redeploy that cash tax savings into new investments that are tax efficient, and really just kind of keep that rolling. So seeing the journey of my clients go from, definitely high net wealth, but taking that to kind of next level it has been really exciting for me. So 25 years public accounting, graduated from the University of Arizona. Our office is currently in Phoenix, Arizona. So Arizona native, been different parts of the state, but we serve clients. I would say probably 75, 80% of my clients are not Arizona based. So we were fax phone even before email and internet and Zoom, that kind of stuff. So we've somewhat mastered the paperless world. So
Prior to the pandemic, right?
exactly.
Yeah. So tell us a little bit about your wealth strategy as well, Casey, personally, right? So I know you've been deploying a lot of the, different tactics and strategies, that I've learned from you into your personal life as well. So how has that really worked for you?
So with my own personal wealth strategy, become an equity owner of Provision. That was definitely in my wealth strategy. You see business owners and you see employees. Employees can make a fair amount of money, but you really don't get that substantial wealth unless you become a business owner. That being said, I've become an equity owner, and I've taken those surplus earnings. There's only so much that you need to live off of. The rest I redeploy, and I've been doing quite a bit of single family rentals in the Arizona market, which fortunately I purchased at the right time when interest rates were 3%, 2.5%, 3.5%, and prices were super cheap. So I've been able to enjoy the benefit of that. Market's been a bit overinflated, so I'm kind of on the sideline as far as purchasing new things. I am looking at getting involved in some franchises as well and kind of redeploying some capital there into kind of a new technology franchise, in really just taking that wealth to the next level.
Yeah. Awesome. So I just want to unpack one thing that you said there, which is really, I mean, it was a very simplistic structure. I think we all took the purple pill and read, Kiyosaki's cash flow quadrant. But that was one of the most insightful concepts that I really picked up at the time, right? Was that, you've got the employee, you have a self-employed person, you have a business owner, and you have an investor. And I knew that it was very tax advantaged, right, to be on the right-hand side of the quadrant as a business owner and investor. But really, until I started, working, closer with you and really started learning more. And you correct me if I'm wrong, but I would really summarize this to people is to say, look, as an employee, you're paying the most in taxes, okay, bar none, employee or self-employed. So the key is to become a business owner. If you're a business owner, then you should be paying 20%. I would throw out as a bar 20% or less, right, as a business owner. And as an investor, if you're deriving the majority of your income through passive investments, you could get it down to zero. Would that be fair to say, Casey?
Definitely. The tax code is a series of incentives, and it's an incentive for a business owner. So if you have a business that's employing 20, 30 people, that one business is doing what the government wants you to do. So the incentives are all about the business, and the employees are really the ones that don't get a lot of the benefits, especially after the recent tax act, where standard deductions almost went away for employees, especially with the 10,000 cap on income tax. So if you're in California, you were typically, if you were a high W-2 earner, you typically had a lot of deductions because you paid a lot of California tax. The 2017 Act reduced that to a cap of $10,000. So, in the past, you would buy a house, you had state taxes, property taxes, charity, you get to itemize. So there were some incentives on the individual side. Those are almost all completely gone because the standard deduction is so high. So, the one saving grace that employees had in the past, that's almost gone as well. So it really is about businesses, small businesses in particular, get a ton of the incentives in the tax breaks.
Right. And you said something really key there, right? Which I think is a big paradigm shift for most people, right? It's about really realizing that, taxes are a roadmap of incentives. if you're a business owner and investor and you understand them and how to deploy them. If you don't know, you just think of it more of as something that you have to pay because you're, on the left-hand side of the quadrant, right? And we just have to pay these taxes. But do you think that there are still advantages for people if they are employees and earning their income through W-2 means that they could create a side hustle business and take advantage of some of those aspects of a creating business?
Yeah, definitely. So the side hustle business, assuming that you're doing the side hustle for profit, which, is the first hurdle. So you're in it to do business, but then that unlocks the deductions that you might be able to get for home office, for vehicle, for dining, for travel, all these different type of expenses where if you're an employee and you have a vehicle, no deduction. Employee, you travel, no deduction. Employee going out for meals and talking business, but still no deduction. You do a side hustle, maybe you're doing some kind of Amazon online sales, maybe you're doing some small business, whatever is generating revenue. You might be doing some Airbnbs. I have a lot of clients that have done that. You might be doing some single family rentals as well. And so just really kind of opening the book to have access to all those tax deductions. So definitely can't be estimated as far as the benefits of those tax deductions when you are kind of moving from employee mindset into that small business mindset.
Yeah, for sure. A really great step. And then another, key step that, I started off with you guys, which I thought was just so powerful. And the majority of CPAs I find are actually looking at taxes in the rear view mirror, right? So they want to just get all of your statements, work on your return, and just kind of, do the filing right from that standpoint. But one of the first things I did with you guys was actually try to understand, my vision, my strategy in terms of, where I was going with the business, what did the future look like, and then creating, a proactive strategy to align to that. So can you speak to, how you really set that up for clients and what is the approach to do that?
Sure. So the easiest way is to kind of say what we're not. So most people are used to maybe never talking to their CPA or accountant, whoever prepares their tax return until, somewhere around March, April. They do it and it's, a surprise. Hey, I owe, or hey, I get a refund, and great. Or, there's really not a lot of planning. So with our clients, the majority of our clients come on board and do a strategy or a tax reduction plan that we kind of say, okay, we're going to have a series of 6 meetings. So it's a prepaid engagement. So they're not having to worry about, are we going over on time? Is it, they know they're going to get 6 meetings with us. We kind of lay out all of their assets, all of their investments, all of their businesses, and kind of put it on the table and say, okay, we look at it for a couple ways. One, we look at asset protection. We're not attorneys, but we do help structure what those entities would look like for asset protection, and then we'll discuss it with the attorney and make sure that we're using the proper states for the best asset protection. But then we also look at, on a tax efficiency side, hey, what makes the most sense? Should you have a corporation, a C corporation for this? Should you have an S corporation? Should it be an LLC taxed as a partnership? And there's not a one size fits all. So we really dive into what the clients what they're looking for, and also look at what their future exit is. So you might have someone that says, hey, I'm starting this company, and in 5 years I'm going to sell it. I'm going to basically get it tenfold to what it is, and then I'm going to exit. That might be a different structure than someone that says, hey, I'm going to basically have this business and I'm going to pass it down generation to generation, or lots of different structures. You might be in a state that a certain entity makes more sense versus less sense. So Tennessee comes to mind with some of their franchise tax, where if you have an LLC, they may add tax to it. If you're in California, you have an S corp, you have additional tax on it. So there's different nuances with each state that says, hey, maybe an LLC is the best, or maybe an S corp is the best, or let's utilize a C corp because we have these other needs that are going on as well. So we definitely look at it from the holistic point of view. In addition, I would say that Most clients come from a background that they meet with their accountant, CPA, and they really it's almost as bad as going to the dentist, maybe just right above it. With our plan where we have these 6 meetings that we go through, and each meeting I'm kind of quantifying, hey, you were paying this much tax. I was able to, in this 1 hour that we talked about these 6 different strategies. We're now lowering your tax $60,000 next year. So they're super excited. I mean, their next question is, okay, well, when do we have our next meeting? Let's go through this and really understand how to do it. And so we educate our clients as far as, there are tax deductions out there. There are incentives out there. We'll show you what they are, but then we're also going to help you make sure that you're setting it up and you're doing it. And the more education that the client has, the more they can bring to me and they say, hey, you know what, in my business, I'm doing this. And then we start going, well, actually, there's an incentive for that. We could go and look this route. So the more dialogue that we have with our clients, the more back and forth, the more questions we ask, the more we can help them. So most of my clients look forward to our meetings. So definitely above the dentist.
Right. And what would you say is really the problem with the industry? I mean, why is the industry seems like it's a completely opposite of what you're talking about?
I would say it's easy. So, I have lots of clients that come to me, they're new clients, and they'll say, hey, my last CPA didn't want to do this because they said it was a red flag. They didn't want to do this because XYZ. There is always, 1,000 reasons why the CPA didn't want to do it. For us, we're not afraid of audits. We've defended many clients. We've taken to court many of our clients. Not that we want to, because IRS audits are just a resource suck. So they just drain. We're totally fine going against the IRS. We have no problem with that. But it is a waste of everyone's time and effort. And so we're not afraid to invest in our clients. And so it's a lot easier if I can just have a client and I just take their information. I don't even need to talk to them, and I crank out a tax return and here's the bill and see you later. It's a lot more difficult to go through the client, really understand their business, kind of lay out their goals and their plans. And it's been done that way for the past 50 years, past 100 years. And so that's kind of the industry standard. So we are unique in that, and we do specialize in entrepreneurs. And there's a reason we specialize in entrepreneurs, is because they are beneficial. They are beneficial recipients of the tax code. And so there's something that we could do with them. We also have high net worth W-2 earners. I have many, Silicon Valley type, California, high W-2, Facebook, Google, that kind of stuff, Apple. But the key is they make high W-2, but they're also looking, into that side hustle, or they have a spouse that's looking into doing this, or, they're looking to set up kind of that wealth strategy. So, when they're done in 10 years of work in Silicon Valley, what kind of retirement do they have, and not just 401k or anything like that. It's more just investments that are under their control, or that, have a greater return or has provided tax benefits along the way. So as long as they're W-2 employees, but they also have some entrepreneur spirit or some kind of side hustle or some kind of other alternative investments, we can help them.
Yeah, for sure. The challenge for me, I mean, this really hits home with me, Casey. When I started a business, I mean, the first few years of starting a business are always great because, everything is upside, right? And you're excited, you have purpose, you have a mission. And then you start making some profit and you realize, you have a tax liability. And I just, I was never more frustrated than, finishing a year. We just do our annual presentation, right, to the employees and everyone. We made decisions about what our budget's going to be for the next year and the whole things. And we would then get this bill in March and understand what our tax liability was. And it was completely underestimated almost every time. So I had this huge pain point, as a business owner, as an individual, as to being blindsided by what my tax liability was, number one, and not able to, efficiently prepare for that. And that put me on that quest to say, okay, maybe we need a new CPA. We need a better person on our team that's going to handle this. And we went all the way up the ladder, paying a lot in fees. Every year we'd pay more and more. We ended up with some very big firms, but they really had the same exact approach. So I can say now, thankfully, that it's been great, working where you have this year-end planning session, and kind of what Casey was talking about as well is you have an active relationship with your CPA that you're working on, what's happening in your business, what's changing in your life, things like that. So you can proactively structure things and then make decisions in that way. My entire family understands taxes. I mean, it's really, nowadays it's really funny. No matter what we do, where we go on vacation, what kind of, what we do with our vehicles, like, I mean, our houses, our investments, everything, has some type of tax, consequence to it. And we're thinking through that. And that's the other, really big learning lesson for me that I had is that you really need to be an active participant, in this tax strategy, right? And working with a really good CPA and having them on your team, you're going to learn a lot, but you also have to take actions, right? And you have to be thinking, in line with what they're talking about in order to see the results.
Definitely. Back to your comment on being surprised on the tax bill come March, April. A lot of clients come to me and the prior CPA's response was, don't make so much money. That's not really a way to grow your wealth, is if your incentive is to not make money. That is absolutely ludicrous. So but as far as the wealth strategy and kind of saving those taxes, if you think about, if I'm able to take someone and lower their taxes, let's use round numbers for simplicity of math, but let's say 100,000, and you're able to take that 100,000 and redeploy it into maybe a single family rental. So that's with leverage, that's a $500,000 investment. Appreciation, you have rental, you have the tax benefits that go with it. You just increased your wealth, fivefold with that $100,000 tax savings. So you could either, give it to Uncle Sam, or use that 100,000 on a tax efficient investment and really kind of grow that wealth. You might be able to have 100,000 tax savings, invest in some kind of oil and gas opportunity that has residual returns. You're getting the benefit for it. So we're always looking at ways, lower the tax, and how do we redeploy that tax and the tax savings into some kind of investment strategy.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah, absolutely. And that's a great segue. So why don't we, I think we did a great job, covering really the strategy piece. So maybe let's talk tactics a little bit. I know it is year end, right? So there's still an opportunity for people to, make some moves on the chessboard right now with your tax planning. But so let's talk about, specifically oil and gas. We have a lot of investors who have invested in oil and gas opportunity. So can you talk to us a little bit about, IDCs and how the structure kind of works from that perspective?
Sure. So oil and gas, there's a couple different options that you can go as far as are they already income producing? So if they're income producing wells, you may not get as much tax benefits as you would if it's something that's developmental and exploratory. So that's where the IDCs, or the intangible drilling costs, come from. And so you might have, $100,000 investment, again, for simplicity, using round numbers, and you might get $80,000 deduction the first year, maybe $90,000 the first year, and then, some residual in maybe year 2 or 3. The tax code is incentivized for oil and gas in this kind of exploratory developmental type oil and gas in that they give you that deduction. And most investments, so if someone was to invest 100,000 in let's say provision, and they just gave me money and said, hey, invest. If we generate losses, they would have passive losses. It would offset passive income. If you didn't have any passive income, then it just carries forward until either you dispose of the activity or you generate some passive income. So if you're a W-2 employee, you're making, a few $100,000 a year, maybe $500,000 a year. You invest 100,000 in a passive investment. Maybe you get $100,000 loss, but you're not going to be able to offset that W-2. For oil and gas, when you're dealing with IDCs, they will allow that to be deducted against your W-2 income. You do have to hold it as a general partner during the time of getting that IDC benefit. So typically what I've seen on the oil and gas ventures is you have a limited partnership. In the first year, you're going to be the general partner, maybe year 1 and 2 general partner. Typically the oil and gas have some kind of insurance that cover it because as a general partner, you do have exposure. And then you generate those losses. And then typically once those losses are exhausted and you start turning it into income, you would flip it to an LP interest. Or if the oil and gas doesn't do that, then you'd move it into maybe your own single member LLC or some kind of asset protection that you have control of.
Yeah, great. And do active losses in oil and gas carry forward like passive losses?
So if you had a non-passive losses or active losses, and let's say that you had 500,000 of oil and gas losses, and you had 300,000 of W-2 income. So you would be able to offset your W-2 income. That would essentially create a net operating loss because it's non-passive. So now it's like a business loss, and you could carry that net operating loss forward for future years.
Got it. Okay. And another big question I think a lot of people are looking at, right, is people might have investment entities or a trust. Would they be able to receive the tax benefits if they invest in the entity or the trust, or is it better to do it just in their name?
So I've had a lot of clients that have come to me and by mistake put it in an LLC because they are first and foremost thinking about asset protection and not necessarily keeping in mind the benefits. So when you have a single member LLC, it's disregarded for tax purposes, but not for legal purposes. So a lot of times clients will confuse that disregarded and say, oh, I can just throw my oil and gas investment into my single member LLC. It's disregarded. Again, disregarded for tax, but not for legal. So since it's not for legal, it gives you that liability protection. And so really those incentives for the oil and gas go away if you hold it in an LLC. A trust would be kind of a gray issue as far as, what type of trust is it? Does it give asset protection? Living trust typically doesn't give asset protection. I think it's safest to invest in your individual name first. And then if the oil and gas partnership does not flip your interest from a GP to an LP, then I would go ahead and move it under a single member LLC or some kind of asset protection trust or something towards that in year 2 or 3, just so you're covered on the asset protection side, but you were able to get all the benefits on the tax side in the first year.
Yeah. Yeah, you're able to just change it later on down the road.
Correct.
Yeah.
Yep.
So, and I know that actually investing in energy is, one of the top 7 items that Tom listed in his latest book, win-win tax or wealth strategy, right? So any other thoughts around investing in energy or any other particular asset classes or moves that you would do, especially as it relates to year end?
So on energy, there's definitely some solar benefits out there. So for 2022, we still have 100% bonus depreciation, which essentially means that you can have, so back in the day, Section 179 was the big write-off that people use buying equipment, but Section 179 was limited to the income. And so if you had an entity that produced 0 income or a loss, then Section 179 was really not a lot of benefit. The bonus depreciation lets you write off 100% of equipment in that first year, even if you have a loss. So that's where all these losses are coming from. in something like solar or the IDCs, you're depreciating all that equipment. 2022, it's still 100% bonus depreciation. And then it starts getting phased down 80% 2023, 60, 40, 20, and then ultimately it goes away. So definitely 2022, 2023, there's a lot of benefit there. Solar, again, is another write-off. Likely it's going to be passive losses, but if you have other income, you might have other investments that are generating passive income. So you might be looking for some passive losses. So energy, oil and gas, solar. Real estate, I'm a huge believer in real estate as far as the tax benefits of it and wealth creation of it. Hands down, I think it's just a great investment and tax vehicle for that. So by default, rental real estate is passive, so you're generating passive losses that offset passive income. If you or your spouse could become a real estate professional, now maybe we have some benefits that we can turn that from passive loss into non-passive. Again, if we have real estate passive losses and they just carry over year, that's not necessarily a bad thing. You might have in a year. So I do quite a bit of syndications as well for real estate and apartment complexes. In this past year or two, there's been a lot of turnover as far as they had the property for 3 to 5 years, peak market value, they sell it. Now you have this huge gain. So there's actually, you could have these passive loss carried over from 1 year, let's say 100,000 carryover loss. Let's say you have 200,000 W2, you have $100,000 capital gain from real estate. You can actually free up that 100,000 of passive loss to offset your W2 tax at a higher rate. And then the capital gain piece is still going to be taxed lower. So there is, even if it's a carryover, there still could be some potential benefits down the road for that. So real estate, oil and gas, conservation easements have always been something that the IRS does not like. There's something called the EARN Act that's probably will be passed in December. That's going to not necessarily get rid of the conservation easements, but it's going to severely handicap it to where at most, if you put 100,000 in, you get your $100,000 cash back. Currently, the next couple of weeks before that EARN Act passes, there's still opportunity on that. Again, it's a reportable transaction, listed transaction. There's a ton of risk and exposure there, but really, so those would be kind of passive investments. If your business, really, we deep dive into your business and look to see what kind of deductions can we get and how do we go about it. I've also have had to do reverse planning, and so you might have someone with itemized deductions of, let's say, 40,000, and we get them into zero adjusted gross income position. They have 40,000 of itemized deductions, so mortgage, interest, property tax. That 40,000 does not carry forward year over year. So I've actually reverse planned it to get them at least to 40,000 of income, all things being equal. If it's just moving it from 1 year to the next year, increase their income, assuming that we could, if we had that control, increase their income to 40,000. Now they don't lose that $40,000 itemized deduction. Then the following year, we have that $40,000 deduction in their business. So, we've looked at it that way. In addition, we've always looked at it. So I mentioned earlier where you have a C Corp, you might have some qualified dividends that you're distributing out. If your taxable income is about 80,000 or less, I say about because it's adjusted for inflation, capital gain rate is actually 0%. So, you might be in that loss position where you have 0 AGI, you have 40,000 of itemized deductions that you're going to lose. If we distribute 120,000 of qualified dividends from a C Corp, now we're utilizing that $40,000 itemized deduction. Our taxable income is 80,000. It's all capital gain. So the capital gain rate is 0. So we just took out 120,000 tax-free by really kind of thinking about it. So it's not always just how do I lower my taxes, but it's how do we, on that 1-year plan, 3-year plan, 5-year plan, how do we make the most tax efficient, through this whole series?
Yeah, I love that, Casey, because you're really doing financial engineering, right? And like you said, you're kind of looking at the entire picture, versus the typical approach, right? Which is looking in the rear view mirror and just, send me your statements, right? So you're doing proactive planning on how to, make the moves on your chessboard and really, create your own chessboard, not play someone else's.
Definitely. Definitely.
So let's go back a little bit, because we do have a ton of real estate investors who listen to the show as well, are big into syndications. Obviously, bonus depreciation sunsetting, right? This is the last year to get 100%. So do you have any thoughts or strategies as it starts to dwindle down here over the next few years, or do you think that Congress is actually going to put it back into play, or what's your latest thinking?
Good question. If they put it back into play, I guess that kind of depends on the politics of it. I don't. Depending if the House stays Republican as it's looking to go, I don't think there's going to be a lot of tax changes. I know a couple of years ago when Biden came in, everyone was expecting this huge change, but the politics of it, nothing really went through. So that being said, as if things stay the way they are projected right now, I don't really anticipate too much change. If, let's say, Republican takes office in a couple of years as president, there could be some change. So when Trump came in, there was quite a bit of change, and really he turned bonus into, so bonus depreciation has been around since 2001. Before 2001, it was non-existent. It didn't exist. After 9/11, the Bush Tax Act came into play, and they're trying to look for ways to stimulate the economy. At that point, it was bonus depreciation is on new equipment. So if it's a vehicle, it has to be a new vehicle. If it's an apartment complex that you're going to do a cost segregation study on, it has to be a new construction. And so bonus has gone anywhere from 30%, 50%, 0%, from 2001 up until 2017. And then the difference that Trump did, not only getting it to 100% bonus depreciation, but it was on new or existing equipment. So if you went out and bought, a Ford F-150 and it was brand new, in the past, you got the full write-off. In the past, if it was a used F-150, you only got the bonus depreciation wasn't available. 2017 comes around, that used vehicle is now just as you're eligible for that 100% bonus depreciation. F-150, great, $50,000 vehicle, good there. You have a $10 million apartment complex, and you do a cost segregation study, and maybe they look at it and they kind of slice and dice it, and they say, okay, of this $10 million building, $3 million represents 5-year assets, 7-year assets, 15-year assets. Those assets are eligible for 100% bonus depreciation. Before 2017, if it was an existing $10 million apartment complex, it was really not of that same benefit. Post 2017, you had an existing $10 million complex, you got the benefit. Before 2017, you actually had to go out and build that $10 million apartment complex to get the benefit. So still huge opportunity, 100% bonus depreciation. If you look at, say, a $10 million building, maybe you're getting a $3 million deduction, just kind of, rule of thumb. I've seen anywhere from 20 to 40% write-off in that first year with the cost seg. So let's say 3 million. Next year, it's 80% of that 3 million. So, 2.4 million is still a decent chunk to be written off. So, 2022, obviously better than 2023. 2023 still really good. 24, decent. And then, in 2024, it gets to 60%, which, the old bonus rules were 50%, 30%. So we're still, comparatively in a pretty good shape. And then I think it sunsets in 2027 or after 2026, however that math works out. But even after that, it still could be beneficial. It's just not going to be lucrative like it is now. Right now, it's just, really kind of insane. But
yeah, for sure. So here's a great question. I think a lot of people are always trying to figure out, right? Which is, talk to us a little bit about recapture as it relates to bonus depreciation.
So when you have bonus depreciation, it's on these assets that are shorter lived. So it's not If it's a commercial property, it's 39 year. If it's a single family rental or residential rental, multifamily, it's depreciated over 27.5 years. When you do the cost segregation, you're picking apart some of those assets that are 15 year, 7 year, 5 year. So then when you go to sell the property, you would have recapture on that depreciation. So, but it really depends when you go to sell it, how much value that is. So if you had 100,000 of dishwashers and you had, 100,000 dishwashers in an apartment complex, you go to sell it in 5 years. If you were to allocate 100,000 to those dishwashers, you're going to have recapture. But how we look at it when we do syndications too is we look at what are the value of those. So are those dishwashers still 100,000? Probably not after 5 years in an apartment complex. Maybe they're 15,000 because their lives are basically almost gone. So if you just looked across the board, and some other CPAs might just kind of have full recapture on that, we would look at it and say, okay, what's the value and what's reasonable in that? So if it was a $15,000 value instead of that 100,000, now we have $15,000 recapture. So it's not always 100% recapture what you took. As far as when you get recapture on the dishwasher, it would be at your ordinary tax rate. And so there's timing of that, but again, I would look at the value of it and try to reasonably assess that value as low as possible.
Right, makes sense. And how about for people looking at exits? We also have a lot of entrepreneurs is really in our audience. Know many people who've had some big exits this year. What are some of the typical strategies you recommend?
So exits. So if you have exits of real estate, with bonus depreciation being so great right now, you basically purchase a new deal, get that bonus depreciation. Real estate, you might have a 1031 exchange that you're basically rolling over, deferring that gain. It's deferral. We're not huge deferral people at Provision, but that's one of those that could be deferral through your lifetime. When you pass, you get a stepped up basis, so it could become deferral to permanent on that. If you're real estate or business, there are basically deferred sales trusts that are out there. We don't do any of that, but I have seen some clients utilize that to where it's basically an installment sale. And I'm going to say it's super simplistic because it's super complex, but an installment sale basically says, hey, if I sell something for $1 million and I get $100,000 for the next 10 years, if I were to pay tax on that in the first year, let's say 35%, $350,000, I don't have that cash because I haven't actually received it. So the IRS lets you report it on an installment sale basis. So as you collect that $100,000 each year, you pay $35,000 in tax in this hypothetical example. So if you were to do deferred sales trust at DST, you're basically taking that same concept and doing an installment sale of your business. Again, it's complex and there's different who's in control and that kind of stuff, but that it could be an option for that. Another might be opportunity zone. So if you invest opportunity zone, I believe it's within 6 months of that exit, you at least defer it. And so what you might have is someone that, let's say they sold their business, let's say they sold it for $5 million and they're IT and 100% in IT, but they want to get in real estate. And so they've already kind of laid the foundation for that real estate kind of path. Let's say that they sell in 2022, but 2023, they're going to be real estate professionals. So they're going to have 750 hours. They sold the business. All they're doing is 100% real estate. They're renting, they're doing Airbnbs, they're multi-family complex, they're in the real estate. Bonus depreciation still being what it is in 2023 could be an opportunity for them to generate a big enough loss in real estate to basically then, if you're able to installment sell, report that income in 2023 instead of 2022. In 2022, you're not a real estate professional, so you would not get that benefit. 2023, you are. So if you could time all of those losses from real estate as a real estate professional with that business sell income, you could wipe away a lot of that income. In real estate, it's great because you can leverage. So getting that $5 million deduction you may not have to put all of that 5 million of cash into that to get that type of deduction. So
Yeah.
there's definitely different scenarios on that, but that installment sale just gives you more time to plan, because
Yeah.
it's not easy to pull off big transactions
Yeah.
month
Awesome.
and a half in the year.
Awesome. Really sage advice. And so, Casey, just, trying to wrap things up here. If you could just give investors one thought in terms of what they could do to accelerate their wealth journey, what would it be?
I think the biggest thing is kind of comes back to that tax savings and redeploying it into something that's going to be tax efficient. The old days of work a W-2 job, put in a 401k plan, and roll the dice on the market and hope that it's going. That'll get you, that'll get you what you are. But if you really want to grow your wealth, business, in doing things on the side and really controlling your own destiny is how we look at it. So
Excellent. 100% concur with that one. Really appreciate you having on the show today, Casey. It's just been such a wealth of information. I know people are going to get a ton of value out of it. If people would like to learn more about what you're doing, connect with you, what would be the best place?
Sure. So we have provisionwealth.com. You can go on there. You can request a free consultation. I would go ahead and in your comment section, reference that you saw us on Dave's podcast, and we'll take care of you. And we'll take those inbound calls and really kind of see, what are you looking? Would this be a good fit? Is there something that we can do? If there's not, we've turned away plenty of people that, hey, there's nothing we can do right now. In a couple of years, when you're doing X, Y, and Z, give us a call. We're here for you. Most of the time, if you're an entrepreneur, there's something that we can do for you. And so that phone consultation will kind of walk through that process as far as, hey, what could we do? And then, so provisionwealth.com, you can call our office line at 480-467-4400. We're in Phoenix. So if you happen to be stopping by in Phoenix, we have a new office that is just about complete. We went down a couple days ago and checked out all the new furniture, and we did a complete remodel. And so we're downtown Phoenix. So if you happen to be in the area, then just come on by.
Awesome. Thanks so much for coming on, Casey.
Excellent. Appreciate it, Dave.
You bet.